it. Okay. So now that we've covered the basics, I want to show you my first strategy. And this is a very simple strategy that is very profitable. Okay. So this strategy is called selling puts. But like I said, don't sell naked. Don't sell naked. Sell cash secured puts. Okay. Now, why do we do this? We do this to get paid every month while waiting for the share price to drop to our desired level. So by doing this, we can buy stocks at a discount or even for free at times. Let me explain how this works. Okay. Now, first, I must say that you only want to buy fundamentally good companies. I keep repeating this again and again. Remember what I said yesterday? Only buy companies that what? Are fundamentally strong. They have consistent increase in sales, profits, and cash flow. They have got low debt. They are undervalued. Remember all that I taught yesterday? Same thing applies today. So please do not do this on speculative stocks. Do not do this on companies that do not make money. Do not do this on Tesla. Do not do this on Neo. Do not do this on Fastly. Do this on safe companies. Do you understand? Okay, right. So let me give you an example of a very good company, which is Yum China. Ticker symbol YUMC. By the way, Yum China is not a Chinese company. It is not a Chinese company. It's an American company that sells KFC in China. All right. And because of the recent China crash, a lot of idiots thought it's a Chinese company. They sold it. Oh my God. And recently the stock price dropped, which is really stupid because it's an American company, right? And they're doing really well because Chinese people love fried chicken. I know because I do. So they're doing really well. They got very little debt, great company. So I already own a lot of shares of Yum China. And I want to buy more shares, okay? For example, yeah? Which actually I do. Okay, so let me give you an example. So let's say Yum China, you calculate the intrinsic value is $54, okay? And right now, you can see it's on an, right, wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down. Now, you guys remember I said yesterday, do you want to buy on a wave up or wave down? Which one? Which one? That's right. You always wait for a wave down to buy. Very good. Because you want to buy as low as possible, right? So good. So imagine here, the price drops wave down to here. So the current price is $50.30 right now, right? This example, $50.30. Now, so question, is it undervalued? Yes or no? Yes, it is. So if you wanted to, could you buy the shares right here? Yes, you could buy the shares, but we are going to play hard to get. We're going to say, you know what? I want to buy at an even lower price because I'm a stingy bastard, okay? So let's say, for example, you decide to buy at $47.50. Okay, you say, okay, I want to buy it at $47.50. I want to get a really good deal here. Okay. Now, if you want to buy it at $47.50, what could you do? You could wait for the price to drop to this level, right? But it may never drop. It may keep going up and you don't get to buy it, correct? So what could you do to get paid money while waiting for it to drop? What could you do? What you do, or what I do, is I sell a put option at this strike price of $47.50. I sell a put option at a strike price of $47.50. Okay, why? So again, let's imagine I sell the Yum China put option at a strike price of $47.50. And it expires in September. Usually I choose an expiration of 30 to 45 days. That is the sweet spot. That's the sweet spot, 30 to 45 days expiration, okay? Remember, why do I sell a put option? To collect premium. So in this case, I sell this put option and I collect a premium of $1.48. You may say, why is it $1? Why? Okay. usually we want to get a premium of at least 2% of the share price. All right. So if you take 148, all right, $1.48 divide by 47.50, you actually get about 3% in this case. So 3% is more than 2%, right? Which is good, right? So you always want to ensure you get at least 2% or more. Why? Because basically what's happening is you're getting a 2% return on your capital in 30 days to 40 days. So 2% a month is what? What's 2% a month? It's more than 24% a year. That's pretty good, right? Right? So that's how you can easily get 24% return a year, right? Waiting for the stock to come to you without even buying the stock. All right? So let's go back to this example again. All right? So again, I sell this put and I collect $1.48. Now remember, one contract is 100 shares. So what's $1.48 times 100? You collect $148. So the moment you sell the put, the money is deposited into your account immediately. You get the cash up front. Okay? Right. So once you sold the put, what are all the different scenarios? What are all the different scenarios? Again, let's look at the illustration here. Right now, the stock price is at $50.30. You sell a put at $47.50. So this red line is the strike price. And this put expires in 30 to 45 days. Okay? So scenario number one. In the first scenario, let's say Yum China, the share price never goes below 47.50, right? So the share price can go up, the share price can go sideways, the share price can go down, right? But it never stays below 47.50. It can even go down and come back up again, but it doesn't stay below that by the expiration date. So in this scenario, what happens? By the expiration date, if Yum China stays at above 47.50 or at 47.50, what happens? The put will expire worthless. And you're no longer obligated, right? And you just keep the premium. So what do? You don't get the shares. Boo-hoo-hoo, you don't get to buy the shares, but at least you get $148, all right? And then what do? For the next 30 days, you sell another put. Collect another $140, sell another put. So you keep doing this month after month after month after month after month until one day, hopefully the share price goes down and you get to buy the 100 shares, right? So again, if you repeat the process every month, 2% a month is 24% a year in the first scenario, okay? In the second scenario, what if the share price from $50.30, it drops below the strike price and stays there at expiration, okay? So if the shares fall and stay below the strike price by expiration, then I'm obligated to buy the shares at 47.50, which is what I want to do anyway, right? Correct? Now, but remember, I have to now buy 100 shares at 47.50, but I already collected $1.48 in premium. So what's my net purchase price? My net purchase price is $47.50 minus $148, which means the actual cost of the shares is $46. So I get to buy at a discount, better than the market. So either way, I win. Does this make sense, guys? Provided it's a good company that you want to own the shares anyway. All right, Vincent, this is a past example. It's not a current example, so the prices are a bit different, right? Now what if the stock price goes below the strike price at expiration and you're obligated to buy the shares, but at the last minute, you change your mind. You say, you know what? I don't want to have the baby. I don't want to have the shares, right? What could you do? Do you have to buy the shares? No, you don't. What you can do is you can, ta-da, If you change your mind about owning the shares, no problem. You can roll the put lower and further in time. What does that mean? Simply, it means you buy the put back before it expires. But of course, if you buy the put back, you're buying it back at a higher price. You lose money by buying the put back. But you sell another put at a further expiration date or lower strike price to collect new premium. The new premium pays for the loss of the old put, which means you still make money. Ta-da! Right? So this method is called rolling the put. We roll the put down and roll the put out so we don't have to own the shares. If you happen to change your mind at the last minute. It's kind of like the morning after pill. You know what? I decided I don't want to be pregnant. Done. Okay? Now, of course, when you take the options course, we're going to teach you all the details, exactly how to roll the put, when to roll the put, and It's all there. But I want to give you an idea that, yes, you can roll the put if at the last minute you say, I don't want a baby, right? Okay, let's take the pill. Does this make sense, guys? All right, okay. So let's look at a live example right now. I know the markets are closed now, but let's look at the charts to look at an example right now. So one example I found, a good company would be AMD. AMD. So first of all, is AMD a good company? Yes, it makes consistent profits and sales. It's a solid company, all right? And is it undervalued? Well, not really. The intrinsic value of AMD is about 101 from my calculation. So right now, the share price is 104. It is slightly overvalued, right? So you may say, okay, I want to buy AMD, but now it's above the value. I want to buy it when it goes below that, right? So can you see the wave up, wave down, wave up? Now it's waving down. Can you see that? So maybe I don't want to buy now. The current price is 104, right? Can you see? I don't want to buy now. I want to buy only if it drops here, when it's undervalued. So you decide to buy at $96. Let's say, right? You say, I want to buy at $96. So what could you do, guys? If you want to buy at $96, what could you do? You tell me now. What do you do? Sell a what? Sell a put at 96. Again, you must make sure that you have the cash to buy 100 shares. If you don't have the cash, you are selling naked. Don't sell naked. Make sure you actually have the money to buy the shares, right? Please, okay? It's like, okay, don't have sexy time unless you want to be a father. Okay, I'm just kidding. All right, so let's go to the option tab here. Okay, and what date to expiration do we choose? Like I said, the sweet spot is 30 to 45 days. So you can choose 1st October or 24th September. Either one is fine, okay? So let's choose 1st October expiry date. Let's open it up. Okay, there we go, right? And we're looking at puts. Okay, so what's the strike price? We chose $96, right? Okay, so if you sell this put at 96, how much money do you get, right? You can see the bid price and ask price is $239 and $245. So you can take somewhere in between called the mark price. Mark is the in between, which is $242, right? So you sell this put, you collect $2.42. One contract is 100 shares. So how much money do you get if you sell the put today? You get $242. That's right. Again, right now, the market is closed. When the market opens on Monday, the prices will change. All right. So you have to recalculate at that time. But now we are just using it as an example. Okay. All right. Good. So in other words, let's look at this slide right here. Oops. Okay. So once again, AMD is now at 104. This is the current price right now. Okay. Right here. We sell a put at 96. And we collect $242 per contract. We get this money right now. And this contract lasts 41 days. Okay. So in the next 41 days, If AMD goes up, AMD goes sideways, AMD goes down, but it doesn't stay below 96, what happens? Then the put will become worthless in 41 days. And we don't get to buy the shares. Damn it. But we keep $242. We are paid to wait. So what do? We sell another one. We sell another one. We sell another one until we get the shares. All right. And if AMD does go down below 96, right, then our put will be exercised and we will be the proud father of 100 shares. We'll buy 100 shares at $96. Right. But remember, although we paid $96 to buy the shares, what I'm saying. Yeah, we paid $96 to buy the shares, but we collected $2.42 in premium. So what's our net purchase price of the shares? 96 minus 242. We end up paying $93.58 for AMD shares, which is not a bad price. Okay? Does this make sense, guys? How do you calculate the ROI? There's actually many ways to do it, right? So my way to do it is I take $2.42, right? This is the premium divided by the strike price, which is 96. So what's the return? Let's see, 242 times divided by 96. That's about 2.5%. Return in about 40 days, right? So that is about 24% return a year, okay? Now, but in actual fact, when you sell the put, you don't need to have all the cash to buy it, although you should, all right? So the broker will actually block about 20% of the value of the 100 shares, right? So your return on your capital is actually much higher than that, right? But to be conservative, I prefer to calculate based on $96, assuming you have the cash to buy the shares. All right. Yes, Francis, you can sell weekly. Oh, why don't sell weekly, right? Why? Because research has shown that when you sell 30 to 45 days, that is the optimum point where the option loses value and it accelerates your profits at 30 to 45 days. That is the sweet spot. Okay. Right. So again, if you guys have watched the interview I did with Olivia from Singapore, Olivia is a very simple person, as in she's new to options. She just learned it recently. And now you can see, every month she's making pretty good profits, right? Every month she reports her profits. And even in the worst month, she made $124 in the worst month, right? That was during the March crash, I think, right? And in July, she made $4,005. And her main strategy is selling cash secured puts. That's it. It's so simple, right? Every month is difficult as stock market is always volatile. No difference this month, especially facing Chinese stock market sell-off. With your guidance and patience, I'm happy to generate $4,005 from the choppy market this month. Option strategies that work were covered calls, cash secured puts, and calendar spreads. Strategies that lost this month was bull bang collar. I'm happy with the gains made as I neither borrowed money or use margin to trade options, right? So, certain strategies work in certain months, certain strategies work in other months, right? This is Rashid. And again, Rashid, he managed to get a 47% return, okay? For his first 1 year, right? Purely investing with covered calls and cash secured puts. That's it. He just used investing, right, which is what I taught you yesterday, plus covered calls, plus cash secured puts, boom, 47% return. Not that difficult, okay? Now, some of you would be saying, but Adam, I don't have the cash to buy 100 shares. Oops, give me a second. Yeah, you may say, Adam, I don't have a big account. I don't have money to buy 100 shares. How? Good news. The good news is if you have a small account and you're not able to buy 100 shares, then you don't sell cash secured puts. But there's another method you can use, which is called, ta-da, credit spreads. So this is the second strategy, especially for people who can't afford to buy 100 shares. Okay, so this strategy is called a bull put spread. A bull put spread, okay, also known as a credit spread. So this strategy allows you to create regular income with limited risk, with limited capital, and a 75% win rate on average. Again, sometimes it's higher, sometimes it's lower, but that's a rough average. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.